Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Shares of Suncor are rising today. It's up about 1.3% right now. The energy giant says it has achieved its production targets 1 year earlier than planned. The Calgary-based company says the achievement was driven by record production in the fourth quarter of last year, as well as its best ever annual upstream production, refining, and utilization. Suncor will give more details on results and outlook when they release their earnings in early February. Copper is extending a powerful rally after topping $13,000 US a ton for the first time ever. Expectations that the Trump administration may introduce a tariff on refined metal have drawn huge volumes of inventory into the U.S. This has also potentially left the rest of the world short of the metal as miners struggle to boost output. Copper's role in high-growth sectors like renewable energy and AI infrastructure have also fueled demand. SanDisk became one of the best performing stocks after NVIDIA CEO Jensen Huang said the memory storage chip market is unserved. Huang added it will likely be the largest storage market, basically holding the working memory of the world's AI. Shares of other storage companies like Western Digital, Micron, and Seagate are also climbing. And taking a look at the markets, the TSX continues its New Year rally. It's up right now about 0.19%. Oil companies improving after that sell-off yesterday. South of the border, also in the green down there. Another good day down in the U.S. You can see the S&P 500 up 0.46. Dow Jones in record territory, close to 0.83. And the NASDAQ up by 0.42 right now. Well, the Canadian energy sector is looking to rebound today following significant losses yesterday in light of the news coming out of Venezuela. Let's get more now on the impact of this on the broader markets from Zachary Hill. He's head of portfolio management at Horizon Investment. Zachary, thanks very much for joining us.
Good to be with you today, Roger.
Is this a short-term reaction and then things will kind of stabilize after today?
In terms of the
oil, yeah, that we saw yesterday into today, it seems like it's bouncing back a little bit.
Yeah, I mean, we think so. I'm no geopolitical expert, but generally speaking, geopolitical events tend to have long-lasting impacts on markets when they interact with real economic variables. And as of right now, that's not something I think that market participants are really factoring in. And so generally speaking, we do think, barring any sort of escalation or broadening of this conflict, we do think that, this is something the market's going to look past. And, over the last few days, at least in the U.S. market, it does seem like investors have been looking past, some of these growing risks.
I know. I was doing the math on the markets over the first 3 days of the year, and if this continues, the markets will be up 72 million% by the end of the year. We're off to quite a good start right now. I know it's not going to continue, but what does it start? What is it looking like to you for 2026?
Yeah, I mean, generally speaking, we're positive going into this year. I mean, one of the things that we've been thinking about is just the opportunity for market participation to broaden. In 2026, we saw a little bit of that at the end of last year, and it's starting to get talked about a little bit more broadly. But generally speaking, I think this idea where all we could do was buy the Mag 7 top of the market, and I think we're switching to a place now where some of the productivity gains and the efficiencies are going to spread out throughout the economy, and we also have tons of stimulus in the pipeline, both in the U.S. and internationally, and so we think those two things together mean that we're going to have a broader market participation both within U.S. equities and in the global equity universe. And quite frankly, I think for diversified investors, that's going to be a very nice backdrop indeed after a few tough years.
Does it feel like with the Mag 7 and AI and that, does it feel like this is a shakedown year? We heard some comments from Wang today about not needing cold chillers. That's had an effect on the markets. Then also memory storage as well having an effect.
Yeah, I think so. I mean, and I think just as we look at intra Mag 7 moves and just some of the trends, the sub trends within the AI theme in general, what we're noticing is that things were very, very correlated with each other, over the last few years, kind of everything going up or going down together. Picking apart the price action more recently, it seems that the people have become a little more discerning in terms of how they're expressing these themes. And so we think, broadly speaking, that's a healthy thing. It means we're getting closer to the monetization phase of this revolutionary technology, and so we do expect that to continue. And it's kind of a thing for the AI trade was a beta trade for the long time. It powered the market, and now we think in 2026 it's going to be an alpha trade, and that's a fundamental difference that investors need to think about when they look at their portfolios.
And where are you looking? Where are you going? Or no, and where are you not going?
Yeah, I mean, generally where we're not going is easy. More positive on growth and expecting, global synchronized upswing. We're not looking at defensives, in like defensive equities or long duration bonds. Those are things we don't like. What we do like within the U.S. is some smaller cap technology, equal weight technology, however you want to play that. Within a stock selection idea in the AI theme, and you compare that with some cyclical. Banks are our favorite in that regard. Large cap banks and the regionals, both of those have some really, really strong tailwinds. They perform quite well, but we think that's going to continue in 2026. And then internationally, we think broadly speaking, owning international stocks as opposed to U.S. index is something that's going to it benefited last year, and when we think there's a chance for the dollar to continue to depreciate, not as much as it did in 25, but to continue to appreciate and be a tailwind, to those more value-oriented sectors internationally.
And any concerns? A lot of the international markets outperformed in New York and outperformed Canada. Any concerns that they're maybe peaking or no?
We're watching, investor flows and how growth, if we do actually see this growth upswing materialize, and that's something that we're going to be tracking throughout earnings season and through this first quarter, and also the behavior of the dollar. The last few days, actually, we've seen a bit of a dollar rally. That might be some of the flight to safety around uncertainty in Venezuela. But I think those two things are right up top of our checklist of what we're going to be watching to see, if this trend continues into this year.
And of course, the Fed. What's your thoughts on where we're going with rate cuts in the U.S. this year?
Yeah, I think we're on pause right now. I mean, the Fed has already cut quite a lot. I believe it's 175 basis points from the peak and 75 basis points last year. And so, I think even if we're on pause for the next couple of months, we're in that stage where, those rate cuts are going to start filtering through into the real economy. And so we think, broadly speaking, that's positive from a market perspective and an economic perspective. After Powell's term is over in May, all bets are off. We're watching the race just like everybody else. Again, that's not a place that I feel like I have any edge. But generally speaking, I don't see there's going to be a huge change in policy. And I think the amount of disagreement we have at the Fed, even now with Powell, who's a very consensus-driven, candidate, I think speaks to just this environment where the Fed's going to be less relevant in 26 than they were over the last few years. And quite frankly, I think that's a good thing for investors broadly.
Okay, we'll leave it there. Zachary, thanks very much for joining us.
Thank you.
Zachary Hill is head of portfolio management at Horizon Investments. Well, Canadian energy stocks are looking to rebound today. We'll bring you more on the aftermath of the military action in Venezuela with BNN Bloomberg's Lindsay Biscaya after the break. Well, Canadian energy stocks are looking to rebound today. The question is, will they? That after those significant losses yesterday in the aftermath of the military action in Venezuela. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. And Lindsay, it was looking Like
it was looking a little brighter.
A bounce back.
Yeah, not so much anymore. For
turn.
some Canadian energy stocks, we're seeing a little bit of a rebound still. Most of them in the morning, yes, it was looking like it was going back up again, but some have dropped. So we'll take a look at a couple. So like Cenovus, for example, we saw some of these energy stocks in Canada drop by quite a bit yesterday, by about 4% a piece. Cenovus went down by about 5%. You can see this 1 week chart. It's just, as you said earlier, like a drop off a cliff on Monday morning, and then we start to see Cenovus rebound. It's sitting just over a percentage point up at the moment. Earlier, it was up by about 2%. Suncor is another one. Last I checked, it was almost up still at 2%. Yeah, 1.3% at the moment. So you can see some rebounds with some of the bigger Canadian energy stocks. Enbridge is down when I checked just a few moments ago. Yeah, almost 2% down. Canadian Natural Resources is also down ever so slightly. But again, there was a bit of a rebound this morning that we saw after that drop yesterday. And all these Canadian energy stocks really just taking a hit to start the week. And a lot of investors, I'm sure, hoping that they will rebound throughout the week after this news. This is not the same thing, but just interesting to note the Canadian dollar also took a hit yesterday. It became one of the worst performing currencies in the G10. So it wasn't the best day for Canada, but hopefully there will be a brighter future tomorrow, maybe.
Well, and investors obviously nervous. What are they nervous about? And we even had the Prime Minister trying to allay some of those fears.
Yeah, so that was interesting to see. So really what's happening here and why Canada is affected by what's happened in Venezuela over the weekend is because of the type of oil that Venezuela produces. So as we've been talking about, that heavy crude oil, very similar to what Canada produces. And Canada exports most of its heavy crude to the U.S. for refining. So the worry is that the U.S., once they've got their hands potentially on the Venezuelan vast oil fields, all the infrastructure, the worry is that maybe some of that heavy crude that we export to the U.S. will be replaced by Venezuelan heavy crude. But as you mentioned, Prime Minister Mark Carney trying to put some of those fears to rest this morning, saying he's not worried. Here's what he had to say.
The Canadian oil will be competitive because it is low risk, clearly low risk, low cost, the marginal costs. There's been huge progress in getting down the costs. We welcome the prospect of greater prosperity in Venezuela, but we also see the competitiveness of Canadian oil, and we're investing, or we're putting in place measures so that that's going to happen. And in that context, a pipeline and exports to Asia, we've got competitive product, and we'd be diversifying our markets, and that's one of the reasons why we signed the comprehensive MOU with Alberta.
So just for some interesting numbers, when it comes to production, Venezuela produces 1 million barrels of oil a day. That's a lot less than what they used to produce. Canada exports about 4.5 million barrels a day. So that gives you a contrast just in terms of that's just how much Canada exports a day. And also, we've had a lot of analysts noting that the infrastructure in Venezuela for extracting that oil, for producing it, getting it out of the ground is very outdated. It's quite battered, and it would take a lot of time and a lot of money. We're talking like billions of dollars to get that infrastructure up and running again. So this would not be a quick process. And also important to note, Canadian heavy crude is mostly exported to the U.S. Midwest. So we've got all the infrastructure, the pipelines in place for the most part to get it there. It's about 10% of Canada's exported oil goes to the Gulf Coast. So there's a potential that maybe in the future, Venezuelan oil could replace what goes to the Gulf Coast. But for the most part, it looks as though the U.S. Midwest is kind of a safe zone for Canada in terms of exporting that oil. But it's still, investors still feeling a little worried about it.
Well, there's lots going on.
Yeah.
Lots of uncertainty.
Yeah.
Okay, Lindsay, thank you very much for that. BNN Bloomberg's Lindsay Biscaya. Well, many stock exchanges pull out the showbiz stops to attract IPOs to their venues, employing lasers, gongs, dancers, confetti, and more. It's a good time, but it's also serious business as exchanges compete for a dwindling number of listings in recent years. Bloomberg TV's anchor Tom McKenzie takes a look at some of the entertaining ways IPOs are celebrated.
An IPO is often the pinnacle of success for executives. There are speeches, hugs, even tears.
I achieved my dream.
The champagne and confetti and countdown clocks might look like a nice party, but it's serious business too. Listings have been dwindling in recent years in the aftermath of COVID and rate hikes to tackle inflation. Exchanges have been competing for a shrinking slice of that pie, and a good show is part of the marketing.
Part of getting the message out is a way that we effectively live the stories that the companies execute through the medium of an exchange. And yes, of course, it reaches out to companies which may be within an IPO pipeline.
Asia has dominated listings for the last few years, and its listing ceremonies mix tradition with pomp and some fun. In Hong Kong, there are gongs of different sizes.
So that's the standard size gong. We also have a bigger gong or a mega gong. That's for very special and larger companies listing in Hong Kong.
So little surprise then that when China's CATL sold shares in May, raising a whopping $5.3 billion, no ordinary ceremony would do for the world's biggest maker of EV batteries. The Hong Kong Exchange wheeled out its mega gong. With CATL shares handily beating global benchmarks since the listing, fortune has indeed been kind to the company. As Europe and the US look to rival Asia by claiming more new listings, the pizzazz, showmanship and company mascots show no signs of being canned as trading gets underway.
And that was Bloomberg TV's Tom McKenzie. We'll have more coming up on BNN next. CUSMA negotiations are set for 2026, and concerns surrounding the implications of the U.S.'s role in Venezuela have added another layer of complexity. Joining us now to unpack it all is Ben Roswell. Actually, we're having some issues with his connection. We will get back to Ben Roswell when we have a chance, but coming up, we're going to take a look at all of that is unfolding right now with Ontario government employees who are now required to work in office 5 days a week, and that's sparking some pushback from workers. CTV's John Venavali-Rao filing this report.
Work-life balance.
With a simple message, these Ontario government workers held a lunchtime protest to show just how they feel about the full-time return to the office.
Frustrated because we were doing well working from home.
These workers had been allowed to do their job from home 2 days a week, but among the tens of thousands of Ontario public service workers now required to be in the office 5 days a week as of today.
It is frustrating. It is frustrating, yes.
Some complaining there's not enough office space to accommodate all of the workers being back full-time. But the Premier says it's all being worked on and will get sorted out.
It's great to get everyone back to work like every other normal citizen. You know, you go out there and you show up 5 days a week.
Ontario's civil servants aren't the only group to see an end to most hybrid work. Alberta's public service is returning to full-time in the office in February, as will Rogers Communications, while many of the country's major banks are already back at the office 4 days a week. Employers argue fewer days at home boosts productivity and leads to better collaboration. But critics disagree and say it leads to, among other things, more traffic congestion.
There's a lot of resistance, and what we also see is that some of the best performers are likely to walk out and leave their jobs by being forced back into the office.
Most federal government workers are required to be in the office at least 3 days a week, but Prime Minister Carney has said return to office rules are being looked at, with more details to come. As for commercial real estate firms, they're continuing to see a boost in demand for office space in cities like Montreal, Toronto, and Vancouver as more workers return to the office full-time. John Venavali-Rao, CTV News, Mississauga.
All right, CUSMA negotiations are set for 2026. Concerns surrounding the implications of the U.S. in Venezuela have added another layer of complexity to that discussion. Joining us now to unpack it all is Ben Roswell, the consultant with Catalyze 4 and the former Canadian ambassador to Venezuela. Ben, thank you very much for joining us.
Thank you for having me on the show.
It is a challenging situation, Venezuela, for Canada. What does it do with it?
Well, this is a frontal attack on the principle of sovereignty, which is the bedrock of the whole international system, and something that every country cares deeply about, not just Canada, Venezuela, obviously. Everyone's happy that Maduro's gone. Like, don't get me wrong, that guy was awful, and Venezuelans are jubilant that he is gone. But the idea that the United States is going to dictate what the Venezuelan government will do, it will just take as much oil as it wants, and the Venezuela will will just get bombed again if they don't like it. Like, that's not going to fly. Not just with the people of Venezuela, who eventually are going to rise up against an American-supported dictatorship, having opposed the Maduro dictatorship. Why would they not oppose the Delcy Rodriguez dictatorship? But other countries in the world are paying very close attention now and taking action to protect their sovereignty. And that's got to include Canada, too. We don't face a military invasion by the United States, but our sovereignty is also being questioned by the Trump administration.
But Canada does have to tread lightly with this because, I mean, we're heading into negotiations for CUSMA, and Trump can turn on a moment. And how careful does Mark Carney, the Prime Minister, have to be on what he says regarding Venezuela and then getting into the talks themselves?
I think we have to approach this from a position of strength. We just tell the Americans that we're going to walk away from the deal if they don't give us what we want. I don't think that treading lightly makes any difference whatsoever. Look at Maria Corina Machado. She's like bent over backwards. This is the massively popular Democratic politician in Venezuela. She has bent over backwards to say, we love you, Donald Trump. I'm going to dedicate my Nobel Prize. She gets absolutely nothing. So being cautious doesn't seem to deliver results at all. And we think that the Trump administration, the most objective analysis that you can give is that they want to establish dominance. And the way that they want to do that is to be as explicit as possible. We're on top, you're on the bottom, you listen to us. If we speak carefully and cautiously and dance around, we give the Trump administration exactly what they want, which is that dominance. And then once they have the dominance, then they can really damage our economy even further. So heading into these CUSMA negotiations, Canada has a lot more to lose by a bad deal than not having one. And we give ourselves better leverage by saying, screw you, we'll walk away if we have to because we're a sovereign country.
What gives us the strength, do you feel, to walk away from them, though? To say we'll walk away from the talks? What are our strong points that we can do that?
Canada is a really significant, large economy, and the disintegration of a very integrated continental economy will cause harm on both sides. There is a lot of pressure within the United States, within the commercial sector of the United States, to pressure the American government. And so once they see the pain that they will suffer, then there can be that the divisions within the Americans. But we also have the rest of the world to trade with. It's true that our private sector has tended to prefer trading with the United States because it's so close and up until now has had a relatively similar set of institutions and values that actually had the rule of law. But now that it no longer has the rule of law, and now that those institutions have been captured by a completely different political system than the one that we're used to, we're seeing a significant shift in Canadian trade patterns already. We have free trade agreements in place with every major economy in the world except for China. We're spearheading discussions about deepening our relationship with the European Union. We're spearheading a lot of a significant expansion of trade into Asia. I think there's going to be some short-term economic pain for Canada in the first place. But until we're more diversified from the United States, we're not going to be able to protect our economy. And that starts by acknowledging that free trade is already dead between Canada and the United States and moving on from there.
Now, the big thing, I think, for trade for Canada, of course, is oil, energy. The oil was heading south. We run the possibility maybe it won't be going south. Do you think we have the political will? It was elbows up and Team Canada. Do we have the political will to build that pipeline to the West Coast?
It'll be a real test of our national unity for us to weather the pain of disengaging from the United States, of sharing the burden of all of the economic disruption that's going to cost. It's going to involve Canadians that are really passionate about fighting climate change and those that are really passionate about exporting oil and gas to find common ground. And I don't want to underestimate how difficult that is. But I had represented Canada abroad for 25 years in all kinds of different countries. I've seen Canadian troops in action in Canada. I've negotiated with the United States. And one thing that I have consistently found is that Canadians are extremely committed to our national interest. and we are really quite committed to one another. We're a far less polarized and divided society than most, and so my sense is that yes, Canada will weather this terrible storm that's coming our way, and that we will stand together as a united country.
Okay, we'll have to wrap it up there, Ben, but thank you very much for joining us.
Thank you for having me.
Ben Rosewell is a consultant with Catalyze 4 and former Canadian ambassador to Venezuela. Well, billed as the world's most powerful tech event, CES 2026 kicked off today in Las Vegas. Bloomberg's Carolyn Hyde is on site and will bring us the latest. Stay with us. Gold Reserve says it is seeking to regain control of its assets after the regime change in Venezuela. The mining company operated gold and copper deposits, which were seized by the country's government. In an interview with Bloomberg News, Gold Reserve says it is already exploring deals that could help develop the deposits under a new Venezuelan government. One of the deposits reportedly worth more than $40 billion US. Prime Minister Mark Carney says Canada is working to expand oil markets in Asia. Talking to reporters in Paris, Carney said he sees Canadian oil as being low risk compared to Venezuelan oil, which will help it remain competitive. In a social media post, Conservative leader Pierre Poilievre urged the Liberals to immediately approve a pipeline to the Pacific coast on the possibility of an end to American sanctions on Venezuelan oil. And Alberta Premier Danielle Smith is pushing for that pipeline after the forced change in leadership in Venezuela. Smith says the recent developments highlight the urgency of such a project. The proposed pipeline will be capable of carrying about 1 million barrels a day to British Columbia, where it can be loaded onto tankers for sale in growing Asian nations. Well, billed as the world's most powerful tech event, CES 2026 kicked off today in Las Vegas. And Bloomberg's Carolyn Hyde is on site. And Carolyn, thanks for joining us. First up, let's talk about NVIDIA and Siemens. Hopefully you can hear us. I know it's loud down there. They just announced an industrial AI partnership. Tell us about that.
Yeah, I mean, just behind me, you're actually hearing karaoke. I mean, who knew that the world of consumer electronics is all about singing as well? But at the moment, this is more about industrial and a partnership that's been coming out with Siemens. We've just been having NVIDIA CEO Jensen Huang sitting alongside the CEO of Siemens, talking about really how AI is now working into the physical world, the engineering world. And I think this is where Jensen Huang wants to point the business. It's about the scale of adoption. Yes, it's about the latest architecture and the movement that we've had from Blackwell to Rubin, and the fact that the Rubin architecture is going to be on people's tables being used in data centers as soon as the first half of this year. Already they've got 6 chips back from their latest innovations from manufacturing partners. So pushing forward on the speed of innovation at the company, but also the breadth of innovation, Roger. I think you're so right to point out that it's about industrials. It's also about robotics. It's about the future of self-driving vehicles. They've announced a new platform for that as well, really challenging the likes of Tesla and Elon Musk, who, by the way, says is not losing any sleep right now. But this is about a company that needs to vindicate a potential $5 trillion market valuation, which is where analysts think this could go this year. How to get there is to show that they own the market share in training and in inference, and they own the scale of getting AI into your hands. I mean, you've heard it from other players as well. Lisa Su on our airwaves just earlier, the CEO of AMD, saying we need to scale compute by 100x in the next 4 to 5 years. And that is why their valuations are vindicated. Everyone needs GPUs coming from these sorts of companies.
And so the demand keeps growing. What about chip CEOs? What are they telling Bloomberg?
Well, I think the demand does keep scaling. And I think that's where you're hearing from Lisa Su saying, look, 100x of compute is necessary. They're getting alongside some of their users. I think 2026 is all going to be about vindication of return on AI investment. Look, we know the amount that these companies are having to push forward their innovations, their latest chips. We just had Lisa Su of AMD saying that they've got a new corporate data center offering So that's going to be the MI440 that already aligns itself with the rest of the architecture that they offer, and they're meant to be the key competitive force against NVIDIA, for example. But there's adoption in companies from fintech to healthcare. They're saying this is actually in the wild being used. But it's also not just so much about the hardware and the chips. It's all about what goes into the rest of the ecosystem. Why NVIDIA has been so dominant is because of the software that goes alongside, the innovation that they can do along partners, such as, well, we had Lucid CEO here on the show a little bit earlier. He's all about the future of electric vehicles, but also the future of robo-taxis. Now, his electric vehicles are partnering with NVIDIA to have full self-driving, maybe even level 4 in the next by 2029. So you're hearing real innovations in the scale of adoption. That's what's needed for 2026, that vindication and proof point.
Okay, Carolyn, thank you for that. Bloomberg's Carolyn Hyde. Coming up, we'll have an outlook on Canadian banks. We're going to talk about what may be possible for the Big Six in 2026. Stay with us. Global uncertainty continues. There's been a lot of guesses on Canadian banks as well. How could U.S. trade uncertainty shape and affect the outlook for the Big Six for 2026? Let's ask Carl D'Souza, SVP at, Morningstar DBRS. I got a frog in my throat there. Carl, thank you very much for joining us. I'll see if I can talk now.
Thanks for having me, Roger.
How are the banks looking right now as they at the start of 2026? They came off a good year. Are we expecting a repeat?
Yeah, so Roger, they did come off a very solid year, supported by their capital markets and wealth management businesses and fee income, which helped bolster revenues and net income. Heading into 2026, our Canadian banking sector outlook is unfavorable. And just to clarify, this refers to the operating environment where we expect tariff-related macroeconomic and geopolitical uncertainty to linger. So the environment heading in, as we're in 2026, the baseline macroeconomic outlook has generally improved, and stimulative fiscal and monetary policy should also support growth. But looming risks add key elements of uncertainty that can negatively affect GDP growth, unemployment, and inflation, all important things that drive bank performance. So we do believe that pressures from sectoral tariffs will likely result in further credit deterioration for the Big Six banks in fiscal 26 before provisions for credit losses or PCLs potentially peak in the second half of the fiscal year. And then we also note that the Canadian and U.S. economies could experience adverse effects if upcoming negotiations on the CUSMA trade agreement prove problematic and or the U.S. decides to exit the agreement. So having said all that, to answer your question, nonetheless, we expect lower but still solid year-over-year earnings in the fiscal year, reflecting higher credit costs, slower net interest income growth, and lower capital markets-related revenues following a record year last year.
I mean, that says a lot about the banks that you're talking about. You factored in the possibility that CUSMA may fall apart, and yet you still think they'll have they have the possibility of a good year.
Yes, and there's several reasons for that. So the interest rate cuts in 2025 should continue to provide some relief for borrowers with respect to debt servicing costs as maturities continue to reprice. Why we do expect that deterioration is that there will likely be a pause on further rate cuts, and there's a widening income gap. And those sectoral tariffs that I mentioned will continue to pressure pockets of borrowers. However, the Big Six banks maintain very diversified business models that have proved resilient and provide earnings resilience in the face of an uncertain and potentially volatile operating environment. As I mentioned, fee-based income by geography and product should enable the Big Six to bolster overall earnings and mitigate any lending income pressures from slower loan growth and broadly stable to slightly improving net interest margins. So that diversification and also that exposure that several of these Big Six banks have to the U.S., which is a more resilient economy, in a much bigger market that drives those capital markets and wealth management revenues, will continue to help boost, revenues and maintain that earnings resilience.
And what the other one along with trade that you mentioned was geopolitical concerns. What are some of the possible headwinds that you're looking at and factoring in?
Yeah, so we've seen, there's lots of things going on right now. The Venezuela situation, and the ongoing conflicts with Ukraine and Russia, and some of the other conflicts as well with in the Gaza. So we're seeing how all these continue to develop and evolve and how those might have more global implications on growth, as well as obviously the trade impacts that I mentioned earlier as well. So the combination of those things skew risks to the downside in 2026, but we remain optimistic that, cooler heads will prevail, the trade situation and Kuzma will hopefully be resolved, in an orderly manner. That will enable the operating environment to not experience some of that harder downside risk. And then I think the big six banks as well are also focused on cost discipline and several undertaking restructuring programs. So that will help them to manage non-expense growth, which will be key to delivering positive operating leverage.
Did you look at AI at all and the impact on the banks and incorporating it?
We did look at AI. All the banks are talking about AI, Roger. I mean, there's two banks that have actually quantified AI, being TD and RBC. And, they're projecting revenue uplift and cost savings. And all the banks are deploying AI in various forms, but I think there's still, time to develop here to see tangible results. And they will continue to maintain those expenses toward AI as it's an important part of future productivity and efficiency, as well as I said, potential revenue uplift. So, all the big six banks have big budgets that they can deploy here, but as I mentioned earlier, RBC and TD have quantified some potential gains from AI, but those are looking a few years out, some of those targets. But in coming years, including fiscal 26, we expect more progress on that front.
And what are they saying? Like, what kind of savings are they projecting?
So TD is, I think they projected potential $500 million in revenue uplift, $500 million in cost savings, and in the medium term, although they didn't necessarily qualify exactly when that would be. Their medium term in their recent investor day was 2029, but they did not specifically quantify that 2029 year for those AI gains that I mentioned. And RBC has, I believe, 2027 for up to $1 billion in AI enterprise value, although they did not carve out or separate that into what would be revenue uplift versus cost efficiencies.
Okay, we'll leave it there, but Carl, thank you as always for joining us.
Thanks very much, Roger. Appreciate it. Carl
D'Souza is SVP at Morningstar DBRS. Still ahead, today's hot picks in luxury stocks. Time now for Hot Picks, and we're doing it in luxury. Earlier, we discussed three companies benefiting from the wealth effect and higher-end consumer spending trends. We were joined by Marcus Hansen, portfolio manager at Vontobel Asset Management, and he kicked things off with why he likes Financière Richemont.
We're a global asset manager, so we're always looking for fantastic franchises and brand companies, which can complement, good performance in U.S. assets as well. Keep in mind, we're looking also at diversification. Consumer discretionary is an area we find some great franchises. And so coming to Richemont specifically, this is a Swiss-based company, which is a holding company for two major assets, one being Cartier, the other one is Van Cleef & Arpels. So two of the iconic top brands in jewelry. It's a 120 billion market cap company with about 26 billion of revenues. 80+% of the earnings come from the jewelry business, which is benefiting not only from a long heritage, so there's a proven track record here of over 100 years. We look for good proven track records, but more importantly, pricing power and strong demand as we see jewelry moving more and more towards branded. Good delivery, good execution, we think is a great one to have. And this is a company which is part of the whole luxury high end, very much is a combination of controlling demand, keeping margin and growing returns.
The chief financial officer at the end of last year apparently warned, though, that higher prices for precious metals are putting pressure on profit margins. That doesn't turn you off?
Not at all. If anything, actually, we think the move in the precious metals market, because there's a combination, they have the ability to hedge going forward and they lock in some of their supply, is actually maybe driving some of the attraction in jewelry that we are seeing versus other consumer discretionary high-end spending. It's interesting also to note that despite these companies, I mean, Cartier itself has been around for 150 years, Van Cleef just over 100 years. They do constantly innovate. And in fact, their new love bracelet, Cartier is renowned for a bunch of different things, but their love bracelet is very famous. They have a new version which continues actually to outsell. And there's been issues actually getting that. So that allows them to have pricing power, which more than offsets what we think would be some of the margin pressure.
Your next idea has that evocative ticker symbol in America, RACE, Ferrari.
Yeah, I mean, you couldn't pick a better symbol, right? Ferrari's been around for, 80 plus years. Effectively, it's a luxury goods company that happens to make cars, so things on wheels. But really, if you look at the remit of its P&L, its returns, its margin profile, it's very akin to some of the top iconic luxury brands. This is a $66 billion market cap company, revenues of about $8 billion. And the story here really is a controlled volume management of this business over time. They could sell more cars tomorrow if they wanted to. They don't, primarily to retain the exclusivity, but also they're aware of the fact that what they're creating here is a very valuable asset going forward. Obviously, a bit of a lackluster 2025, but if you look at the track record here of 3, 5, 10, 15 years, the performance is phenomenal. And we think this will be another one which also benefits from what we're continuing to see is good spending on the high end, but also demand for quality, unique assets going forward.
And then your final name also involves fast cars, Formula One Group. I guess we're not going to be buying these cars, but they are part of the whole luxury ecosystem.
Yeah, so again, coming to consumers' discretion, actually, sports franchises in particular are very interesting. They're very unique. And it's very hard to actually find sport franchises that both you can invest in and also are profitable. Traditionally, actually, things like teams don't actually make a lot of money. Formula One is very interesting. Formula One has been around since 1950. And here what you're buying is an asset which was part of the Liberty Media Group, which was originally a tracking stock. And this is a new investment for us. We liked it because they converted it into an asset-owning operation. So the F1 Group basically has the right to manage the F1 Formula One racing brands around the world for a long-term commitment. They make their money in 3 ways. One is they host races. So cities around the world bid to host races for a number of period of time. There's 24 races every year. The race season runs from around March to December. They also make money from TV media rights. Depending on the numbers you look at, this is the 3rd or 4th most watched sport on the planet. Obviously, there's the famous F1 race in Montreal, but in the United States, it's really been in the last 3-5 years, they've expanded to add a total of 3 races. But outside of North America, this is phenomenal following. And the third area is sponsorships. If you remember when we were kids, most of the sponsorships you saw on F1 cars tended to be tobacco or car and auto parts and oil companies. Mm-hmm. Now the sponsorship has really expanded to include consumer brands all the way from LVMH to Google and other tech companies. And the viewership has also expanded globally as well. The other kicker here is, which is interesting, is that they also acquired MotoGP, which is almost the Formula One equivalent of two-wheel motorcycle racing. That became part of the group at the end of last year, represents about 10% of the revenue base. And we believe they're going to do similar things with how they expand that franchise going forward as part of this Formula One group. So again, we're looking at a business about 25 billion market capitalization, greater than 4 billion of revenues. And we think those 3 lines of drivers can drive consistent top line and earnings growth.
I got to admit, for me, car racing is watching paint dry, but it's one of those sports where when you know, I think, what's going on, you get much more pleasure out of it.
Andrew, can I recommend then watching a clip from MotoGP? If you think F1's a bit boring, MotoGP is faster, the overtaking is a little crazier, and the action and the camera angles are very interesting. So again, definitely worth watching. It's a fantastic franchise and again, sports franchises historically, when we look at these things, the value isn't just from the earnings side, but just the following in terms of eyeball and viewership.
That's interesting. So the motorbike racing, you reckon, has it might draw me in?
It might draw you in. It's when watch a couple of the races, you'll see what I mean.
That's right. Yeah, I remember in my youth they used to have that motorcycle race in the Isle of Man that was infamous. Poor guys would get smashed up doing it.
Yeah, so today, fortunately today safety has come in quite nicely, so it's helping a lot. You've seen that on the Formula One cars, also MotoGP.
Yes.
But really, what's very compelling here is just the global nature of the brand and the franchise's reach. We don't think is reflected in the current valuations.
That was Marcus Hansen, portfolio manager at Von Tobel Asset Management, and the Isle of Man motorcycle races are still insane. Let's take a look at the markets quickly before we head out for the afternoon, and we'll see what's going on here. The TSX first up, and it is up right now, 0.42%, being driven by materials, and it's up. Materials right now is up at 2.7%. And south of the border, you can see another update for the S&P 500 and the NASDAQ as well. That wraps up this edition of Trading Day. Have yourself a great day.